I'm Jeff Bermet, and along with Nick Davis, we are the co-managers of the Libero Cautious, Dynamic, and Solutions funds. October was another strong month for performance in the portfolios, and it was a strong month for asset markets in general. And I think it's worth reflecting on the general environment and what's driving this continued strong performance in equities and to some degree in some bond markets as well. First off, third quarter earnings came out and they were strong, particularly in the AI space. Many of the big mega cap tech firms, namely Alphabet and Amazon come to mind, had very strong numbers because of their cloud infrastructure build out and the demand for data center space. And so the CapEx spending by the big tech firms in the US continues to grow to well over $300 billion, and expectations for 2026 have been raised because all these companies pledged to spend more. This spend is so large that it may in fact be hiding some areas of weakness in the US economy. So it's something that we'll want to watch. On the interest rate front, the Fed lowered rates again. Chairman Powell in his press conference stressed the vulnerabilities in the labor market, and he was very non-committal about would the Fed lower rates again in December at their next meeting. And I think that's really going to depend on what's happening to the US labor market. And the problem is with the government shutdown now in the US, we're not getting any data that would normally be prepared and collated and released by the statistical agencies that the US government runs. So the Fed and we in the markets are having to rely on private sector data that, while is of good quality, there isn't perhaps sufficient breadth in that data to give us a clear signal. So, I think you still have to think of the Fed as risk asset friendly. The Bank of England is watching very closely what's going to happen with the budget here in the UK later this month. If that budget is too harsh in the way of raising taxes and trying to dampen activity, I think the Bank of England would happily lower rates to sort of offset that. So you may get that support for fixed income from the Bank of England. Some of the other themes that we have been running in the portfolio, defense, we're in the early stages of the build out in European defense spending, and we think there's a lot more to run in that area. On the mining front, copper is now up 25% year to date in price because the build out of all this AI capacity in terms of data centers, well, they all require electricity to run on, and transmitting electricity requires copper wires, and we think the miners will benefit from that, as they are also benefiting from production of gold and silver, as the demand for those two commodities also continues to run very high. And then lastly, on Trump, you can never have a discussion about the markets without talking about Trump. He did achieve a bit of a truce with China so that the very high tariffs that the US was threatening China with have been removed. The tariffs continue to generate an enormous amount of revenue. It's running at a sort of $350 billion annual rate. And when you have a budget deficit of $2 trillion, $300 to $400 billion matters. And I think US tariffs on imports are something that we're just going to have to live with. And the US government is, like all governments, going to be addicted to the revenue sources that they have. I'm going to pass it over to Nick to talk about particular holdings in the portfolios that have done very well for us.
It's been an interesting month for us, as parts of the portfolio that have been relatively unglamorous have actually had a very strong month. Samsung, which has been an investment which I mentioned last month, has again had a very stellar month. Again, this demand for chips and the growth in AI spending, and that is driving further and further. So that's actually been a really positive month for Samsung again. Surprisingly, other stocks that have done well this month have been LVMH, luxury goods stocks, Europe. A general feel good in Europe about the economic environment has helped push this stock higher, and plus a feeling that China is also in a slightly better environment, so we may see more demand from China in terms of consumer spending. Healthcare has been a sector that's been absolutely beaten up over the last 18, 24 months. And in terms of valuation, these stocks have been very, very cheap, and we've held positions in various stocks. Sanofi has been our key play in Europe, and again, it's had a very strong month. Thermo Fisher, again a US stock, makes scientific measurement equipment, etc. It's come back very strongly over this period. So it's a reason why we have these holdings in the portfolio. We think about the longer term impact they will have on the portfolio, and at certain points we believe they will come through as the market picks up on their valuations and on their results. The sector we talk about probably ad infinitum is defence sector. We're starting to see the contracts come through, and we believe longer term the impact of European defence spending, which will be generally focused on European companies. We think potentially we're seeing readings from other economists saying this could add at least another 1% GDP to something like Germany. And that kind of economic growth is actually really helpful. The deficits of governments, how do you deal with that? Either you cut spending or you increase growth. And this is one way of increasing growth, by spending money on defence effectively. So again, talking about chips and Nvidia, the key name on everyone's lips. We haven't purchased Nvidia was because the valuation was too painful for us. Samsung we've held in the portfolios year to date is up about 100%. So it's actually looking outside of the bright lights and looking where you see value, and that's what we've done. As I touched on the UK, Jeff mentioned the budget in the UK. It's an area where we have some concerns where the government may be looking for funding. So we've removed the position we had in NatWest Bank, which has been very spectacular for us this year, up nearly 30%. And taken that profit. And we also sold the house builder Bellway. We think it's an area that may suffer in terms of high tax rates and potential property taxes that are coming through. So as there's an element of politics that will interfere with potential stock market returns, we will decide to reduce our exposure to the UK, and we will refocus that once that's happened. Another strong month for all three portfolios, for Dynamic, Solutions, and also the Cautious in sterling terms. Cautious, massively helped by the very strong performance for UK gilts. Again, that portfolio is very low risk in terms of having a majority of its assets in very short dated fixed interest. So finally, year to date, we've had excellent performance from Dynamic and Solutions. I think probably the best years these funds have ever had in terms of performance looking at historical returns. This has really been achieved through us, through the active management and the focus on the key themes that we talk about. It's about focusing on the value of returns for your clients, and that's what we're focused on, and that's why these portfolios have done so well this year. Thank you once again for your support, and we'll speak to you again before Christmas.